Hey guys, Ken Calcutt here with Cornerstone Financial Management. Just wanted to give you another update on what's going on in the markets. Today is November 7th. It's a local election day. The last time we shot a video was probably 3 weeks ago. It was late October. Wanted to tell you what's going on in the market. This is a key chart that we're watching. This is the rate on 10-year Treasury yields. We see it's at 4.58 right now. What happened is we did see that 10-year Treasury yield touch 5%, really around the same time we shot that video a few weeks ago. What we're noticing in the market, the stock market is having a really difficult time when the 10-year yield is at 5% or higher. When this yield runs up towards 5%, stocks are tending to go down. So we're seeing a pretty clear inverse relationship with the stock market and what this chart is doing. So last video was around October 17th. Yields shot up quickly, stock market went down quickly, and then we've seen over the last couple of weeks, this has started to come back down. We're at 4.5 now. That seems to be a manageable level for the stock market to be able to handle 10-year treasuries at 4.5. We're hopeful that this number will kind of stay around 4.5, maybe drift lower. I would not be surprised if we see it run back up to 5 again. It would probably be unusual to hit 5% one time and then just trend lower and not retest that. So we're watching this to see. It'll probably push back up again. That doesn't mean it necessarily goes higher than 5.25, but that's what we're watching, and this is largely impacting where the stock market moves. So we're going to jump over and go over the stock market chart with you real quick. Here is the S&P 500, and we're looking at about a 4-month time frame here. This peak that we saw back here, this was end of July, early August. Then we're seeing a pretty nice decline in the market through that time frame. The last video that we shot was right here. The market had bounced off the 200-day moving average, started a little rally, and then immediately started coming below this 200-day moving average. That was not a good sign. We don't like to see the market drop below the 200-day moving average. This dotted green line is the 200-day. That tends to be a support level when the market's above it. We went straight through it about 2 weeks ago, and that was because 10-year yields pushed over 5. The market can't handle that. Stocks started dropping. Now, we have seen this week, we've seen a very sharp recovery. So we're basically where we were a month ago. It's basically where the stock market is. We had a sharp decline for about 2 weeks, and we've had a sharp recovery. This recovery is correlated with that 10-year Treasury yield starting to come back down. It's back down to 4.5, and we see a nice rally in stocks. So we're seeing a clear correlation here, inverse correlation with 10-year Treasuries and what the stock market is doing. Everything still hinges on what the Fed's going to do. Where's inflation going? Are we going into recession? We just don't know. The Fed has indicated kind of subtly that they may be open to no more rate hikes, which is good news. That's partly why we're seeing this rally. If and when the Fed stops raising rates, I feel confident the stock market probably would start getting some traction at that point and things might start improving. Even if we had a mild recession, that doesn't necessarily mean the stock market goes considerably lower. It's always a possibility, but not directly correlated. So anyway, those are the things we're watching. We've seen a pretty volatile 3 weeks to essentially get right back where we were 3 weeks ago, but that's the stock market. That's what it does. And so it's important to stay balanced. That's what we're doing. We have our growth components. We have our value components. We have aggressive growth. We have fixed income. We keep all those components in there because all these moving parts, it's impossible to know which category is going to be moving the best at any given time. So we'll continue to monitor this. We'll continue to make adjustments as needed. And if you have any questions, certainly reach out anytime. Now, we'll pivot real quick and talk about elections. Today's, like I said, a local election day. We're 1 year away from a big election day. Presidential election year next year. I know most of us are not really excited about dealing with politics and elections and all of the advertisements that go with it, but that's the world we live in. But one of the number one questions we get is, how is the election going to affect the markets? People ask this all the time. It's a valid question. The good news, in my opinion, the good news is elections generally don't impact the markets that much. Election years are kind of a non-event for the most part. Let's show you another chart that I think you can see, at least with a modest history, that that's the case. So this is a chart that's just showing the S&P 500, the SPY, S&P 500 index over 25 years. All right, so I'm just going to point out the election years we've had over the last 25 years, and you can see these little green bars at the bottom is simply the stock market return for every respective year. And we can look back and we can see in 2020, this was an election year. in the midst of what was going on. There's nothing significant about that. 2016, this was an election year. 2012, this was an election year. 2008 was an election year. It was also a financial crisis year, which is why we saw such a drop. It was not because it was an election. 2004, this was an election year. And 2000, this was an election year. If you look at the election years, you can tell they aren't noticeably different than any other year. We have volatility every year for various reasons. Elections can cause volatility because of the perception of what the results might be. But at the end of the day, an election year in and of itself is not noticeably better or worse than an average stock market year. So what we expect next year, probably more volatility, but we get that every year. So we don't necessarily change strategies because there's an election coming up. Long term, we see the stock market does what it does, election year or not. We stay diversified, we stay invested, and long term we expect to get the growth that we want to get. So hope that helps. I don't enjoy election years any more than the next person, but it should not have a meaningful impact on the markets, which I think is good news, and we can stay the course with our long-term plans. So if you have any questions about that, reach out anytime. Thank you.